You just launched a company and you've got your MVP, but you need funds to really scale the business. You're now working on your pitch deck, and now it's time to start building your financial projections. Nailing your financial projections is a super key part of getting funding. You'll need massive confidence that what you're asking for from an investor is backed with thoughtful analysis. Investors are going to ask you questions like, how effective will your go-to-market campaign be? How will you use the funds? How big can the company get in 5 years? So let's dive into how your financial model can result in a higher round. We're going to talk about driver-based financial modeling, the components of a model, key metrics to incorporate, scenario planning, and tools to start your financial model. Investors, whether they're venture capitalists, angel investors, or even friends and family, want to see evidence that your business has a clear path to profitability and sustainable growth. They want to see that you've thought through every aspect of your business, from customer acquisition costs to lifetime value. As startups grow and evolve, they often need additional capital to fuel expansion, enter new markets, or develop new products. A well-maintained financial model provides a real-time view of your startup's financial health, enabling you to effectively communicate your funding needs and the potential return on investment for prospective investors. There is an important concept in financial modeling called driver-based financial modeling. What you don't want to do in your model is just put out a few assumptions like, this is how many customers we will grow by each month. And to get that, we're gonna spend this much on marketing dollars, and this is the team we need to hire. This approach will not get past any savvy investor. The right way to model your business is to understand the drivers behind your revenue and expenses, and to understand the levers that truly impact the financial performance. This entails a thorough analysis of factors such as customer acquisition costs, pricing strategies, marketing trends, and operational efficiencies. By adopting a driver-based approach, you not only gain a more accurate understanding of your business dynamics, but also demonstrate to investors that you have a solid grasp of the factors driving your company's success. Let's break down the components of a financial model. So at the heart of every model lies a series of interconnected components, each playing a role in shaping the trajectory of your journey, from revenue projections to expense forecasting, cash flow statements, and balance sheets. These elements work in concert to provide a holistic view of a company's financial health. The first component is revenue. Revenue projections serve as the cornerstone of any model, providing insights into a company's top-line growth potential. So by forecasting future revenue streams across different business segments or across product lines, startups can gauge their revenue-generating capacity and chart a course for growth. Factors such as market demand, pricing strategies, and customer acquisition channels all influence revenue projections. Going back to our driver-based approach, we would model the effect that sales and marketing has on revenue. So you will spend money on a marketing campaign, and that campaign will drive conversions, or you will spend money on a sales team, and that sales team will drive new leads down your sales funnel. These are the drivers that need to be grounded in reality, so make sure to do research on what other companies achieve in your industry. But let's next dive into expense forecasting. This aspect involves estimating the costs associated with running a business, encompassing both fixed and variable expenses, operational overheads to marketing expenditures and employee salaries. Accurate expense forecasting is crucial for effective budgeting and resource allocation. By anticipating future expenses and identifying areas for cost optimization, startups can ensure efficient resource management and financial stability. Just like with analyzing the effect that sales and marketing expenses have on revenue, we can estimate the effect that revenue has on expenses. For example, in a SaaS-based company, you can tie your MRR, or monthly recurring revenue, to customer service agents. The more users you have, the more customer service agents you will need. MRR is yet another driver that impacts the expense component of your financial model. So having all of your assumptions documented is key. Some investors may want to see what's called an assumptions sheet, which is a summary of all these assumptions that are made, even non-financial metric assumptions, such as assuming that we're getting a permit by this specific date, or that we're buying so-and-so's IP by this date. Another key metric to report on in your pitch deck is your break-even point, which is the time at which your monthly revenue becomes greater than your monthly costs. So your revenue minus your expenses equals your profit or your income. This detail behind this income is displayed on the income statement. Your income statement is just one component of your financial model. So moving on to cash flow statements. These statements provide an overview of the inflows and outflows of cash. Cash flow statements serve as a barometer of financial health, and unlike the income statement, which is subject to non-cash accounting adjustments such as depreciation, the cash flow statements focus solely on cash movements, providing investors with a reliable indicator of a company's ability to generate and manage cash. So you might be confused right now because you might be thinking, doesn't my income reflect how much cash the business generates? And the answer is not entirely. Income statements often include non-cash items such as depreciation, amortization, changes in inventory. These things can distort the true cash position of a company. Additionally, revenue and expense can be recognized on the income statement before cash is actually received or spent. The accounting method that an investor will want you to adhere to in your model is called accrual-based accounting. Unlike cash-based accounting, which records transactions only when cash actually changes hands, accrual-based accounting recognizes revenue and expenses when they are incurred, regardless of when cash is exchanged. This method provides a more accurate depiction of a company's financial performance over a given period, but it can sometimes lead to disparities between reported income and actual cash flow. Therefore, investors often do rely on cash flow statements in conjunction with income statements to gain a comprehensive understanding of a company's financial health and performance. Another part of analyzing cash flow is looking at your burn rate at your runway. Your runway is the length of time you can operate before running out of cash. How about analyzing your burn rate in different scenarios? This is a very common strategy in financial modeling that involves constructing multiple scenarios to provide a multifaceted view of potential outcomes. In the base case scenario, you model out the most likely or expected financial performance based on your current assumptions and market conditions. This scenario serves as a reference point for your projections and forms the foundation for your analysis. In contrast, the worst case scenario involves modeling out the financial performance under adverse conditions or significant challenges. This scenario helps assess the potential downside risks and vulnerabilities of your business, allowing you to identify areas that may require additional attention or mitigation strategies. On the other hand, the best case scenario entires modeling out the performance under ideal or highly favorable conditions. So while this scenario may represent optimistic projections, it helps highlight potential opportunities and growth possibilities for your business. Each scenario offers valuable insights into different aspects of your business's financial dynamics and helps you better understand the range of potential outcomes. So by considering these scenarios together, you can develop a more robust and more resilient financial model that accounts for various contingencies and uncertainties in the market environment. A typical startup will begin raising additional funding from new or existing investors when the remaining cash runway is about 9 months, and the time between raising rounds can range to around 1.5 to 2 years, but this could vary wildly. Lastly, let's explore balance sheets. Balance sheets offer a snapshot of a company's financial position at a given point in time, presenting its assets, liabilities, and equity. So assets represent what a company owns, liabilities denote its obligations, and equity reflects the ownership stake held by shareholders. Balance sheets provide valuable insights into a company's solvency, leverage, and overall financial stability, helping investors assess the business's long-term viability and investment potential. They may dive deep into specific balance sheet metrics as well, like liquidity ratios, which assess a company's ability to meet obligations, or leverage ratios to understand how much debt a company is using to finance its operations and how it compares to its equity. They may also use efficiency ratios to determine how effectively a company utilizes its assets to generate revenue. So understanding the 3 financial statements and using a driver-based approach towards these projections is vital for startups seeking to navigate the complexities of financial planning and chart a path to growth. Next, we're going to get into what tools to use for financial modeling, and then we'll talk about integrating it into your pitch deck so you can go raise some money. So the most common tool used to create financial models by far are spreadsheets, but it's not the only tool. These days, there are online-based, purpose-built financial modeling tools that don't require you to understand how to use spreadsheets. At DeMar Consulting Group, we like to use a tool called Fathom because it's dummy-proof. You can easily make mistakes in Excel if you don't know what you're doing, but with Fathom, the tool is impenetrable. Everything is interconnected, so you don't have to worry about being an Excel wizard. As you tailor your pitch deck, it's about presenting this consolidated narrative. You'll want to extract key metrics and insights from the model that resonate most with potential investors. So highlight growth projections, anticipated break-even, and EBITDA, earnings before interest, taxes, depreciation, and amortization. So you've put in the work to develop a comprehensive model, and it's detailed, very detailed. But when you're standing in front of investors with your pitch deck, it's not the time to unload every single piece of data onto them. What you want is to provide an overview that hits the key points and grabs their interest. In the first pass, your pitch deck should highlight the most crucial metrics and summaries. So think big picture items that paint a clear image of your business's financial health. If an investor is keen to know the specifics behind, say, a revenue projection, you should be able to provide that. And this is where having a few extra slides in the appendix of the pitch deck comes in handy. They're there for reference should you need them, but they're not part of the main show. So don't volunteer to share your entire model to an investor unless they really need it all. It's about striking a balance, giving enough to demonstrate you've done your homework, but not so much that it uncovers more than necessary. You want to keep an investor at a little bit of an arm's length, at least at the beginning of the relationship. The initial pitch aims to get their attention and makes them want to explore further. So at DeMar Consulting Group, we're excited to introduce our latest initiative, the Financial Modeling Workshop. This program offers personalized guidance as you construct your financial model. On the first day, you'll receive a blank model to kickstart your journey. So from there, you'll have the opportunity to engage in 2 hours of monthly sessions with a seasoned analyst. These sessions will assist you in developing your financial model. Our approach is designed to empower you as the founder to build your own model with guidance from a professional. So if you're ready to start, you can secure your spot by booking through the links in the description. We're here to support you every step of the way.